In one single weekend, a company worth over $600 billion simply disappeared. This is the true story of Lehman Brothers. For over a century, it stood as one of the most trusted names on Wall Street. It was considered too big to fail until it did. It happened over just 3 days in September 2008, 3 days that reshaped the entire global economy. Lehman had survived the Civil War, 2 world wars, and the Great Depression. It kept growing, kept adapting, kept surviving. This time would be different. It could not survive one bad bet on the housing market. And when it fell, it dragged the entire world economy down with it. Banks across the globe felt the shockwave within hours. So how does a 158-year-old bank lose everything in 72 hours? It sounds almost impossible. Stick around, because by the end of this video, you'll understand exactly what happened and why it still matters today. Our story doesn't start with Lehman. It starts with something much smaller, a house. In the early 2000s, banks across America started lending money to buy homes, a lot of money, to a lot of people. Interest rates were low, and lending felt almost risk-free, even to people who couldn't really afford to pay it back. Lenders approved them anyway, assuming rising home values would cover any problems. These risky home loans were called subprime mortgages. Banks approved them anyway, chasing growth. Millions of these loans were being handed out every single year. It felt like an unstoppable engine of growth. Wall Street had a clever idea: bundle thousands of these loans together into one investment. That way, the risk seemed to spread out and disappear. These bundles were called mortgage-backed securities. Investors could buy a slice of thousands of mortgages at once, and banks sold them to investors all over the world as safe, profitable products. Pension funds, insurers, even governments bought in. Rating agencies even stamped many of them with their highest safety grade, AAA. Almost nobody questioned it at the time. It seemed like free money. Everyone wanted in. And one bank went further into this business than almost anyone else: Lehman Brothers. It didn't just sell these products, it originated the loans behind them. By 2007, Lehman was the biggest player in the mortgage game on Wall Street. Nobody at the top seemed eager to slow down. At the top of Lehman sat CEO Richard Fuld, known on Wall Street as the Gorilla. Employees respected him. Some feared him. Fuld had run Lehman for 14 years, famous for fighting hard against competitors and critics alike. That history built enormous and possibly dangerous confidence. Under Fuld, Lehman's profits kept climbing higher every single year. Revenue records were broken again and again. A huge part of those profits came from mortgages and real estate. The bigger housing grew, the bigger Lehman grew alongside it. Lehman even bought its own mortgage lending companies to originate more loans directly. That gave it more exposure to any downturn. By 2007, Lehman held over $111 billion worth of mortgage-related assets. That figure rivaled the economy of a mid-sized country. That's more than most entire countries' economies at the time. It's a staggering scale to try to imagine. Here's the dangerous part. Lehman was doing this with borrowed money, a lot of it. That decision would define how fast the collapse happened. For every $1 Lehman actually owned, it had borrowed 30 more to invest. This ratio, called leverage, was extraordinarily high. Leverage makes profits bigger, but it makes losses catastrophic. Lehman treated it as simply the cost of staying competitive. If the value of those mortgage assets dropped by even a few percent, Lehman's entire cushion could disappear. It was an astonishingly thin margin for error. But almost nobody at the top seemed worried. The good times had lasted too long to imagine them ending. For years, U.S. house prices had only gone up. An entire generation of bankers had never seen a nationwide decline. Then, in 2006, something changed. House prices started to slow down. By 2007, in many cities, prices were falling outright. What had been a one-way bet was suddenly reversing. Homeowners who had borrowed more than they could afford started missing payments. Foreclosure notices started appearing across the country. That meant the mortgage bundles Wall Street had sold as safe were suddenly not so safe. Investors realized they held something far riskier than expected. The value of these mortgage-backed securities began to crack. Firms holding large quantities like Lehman saw their balance sheets shrink. This was the start of what the world would later call the subprime mortgage crisis. Lehman was sitting directly in its path. And Lehman wasn't the only bank in trouble. Other firms with heavy mortgage exposure started feeling the same pressure. In March 2008, another Wall Street giant, Bear Stearns, nearly collapsed overnight. A firm that had stood for 85 years was suddenly on the verge of disappearing. It was rescued in a rush deal, sold to J.P. Morgan Chase for a fraction of its former value. Shareholders were left with pennies on the dollar. For many on Wall Street, this was a terrifying warning sign. Lehman Brothers sat right at the top of the watch list. Lehman had the same risky mortgage exposure Bear Stearns did, just spread across a much bigger balance sheet. Investors started asking uncomfortable questions. Publicly, Richard Fuld insisted Lehman was different, stronger, safer. Internally, the picture was far more complicated. "We are fine," Lehman told investors, again and again. Each repetition seemed to invite more scrutiny rather than less. But Wall Street wasn't fully convinced. Lehman's stock price started sliding. Nervous investors began quietly selling their shares just in case. The decline started to feed on itself. Fear was building across the entire financial system. Investors began wondering which other banks might be hiding similar risk. And the deeper people looked into Lehman's books, the more hollow things seemed. Some assets seemed valued far more optimistically than reality justified. Some analysts believed Lehman wasn't being fully honest about how much its mortgage assets were really worth. Lehman pushed back hard, but the doubt proved hard to remove. Later investigations would reveal Lehman used accounting tricks to hide the true size of its debt. Regulators would examine these practices closely after the collapse. One method, nicknamed Repo 105, temporarily moved debt off the books right before earnings reports. It made leverage ratios look lower and healthier. Then, once the report was published, the debt would quietly return. Investors had no way of knowing this had happened. It made Lehman look far healthier than it actually was. That kind of fragile confidence tends to shatter quickly under pressure. Through the summer of 2008, the pressure kept building. Every piece of bad news seemed to land directly on Lehman stock. In June, Lehman reported a massive quarterly loss, $2.8 billion. It confirmed publicly what critics had argued privately for months. It was the first loss the company had reported since going public. Confidence in the firm's stability took a severe hit. Lehman's stock price collapsed by over 50% in just a few weeks. Institutional investors scrambled to reassess their positions. Lehman desperately needed a lifeline, and time was running out. What happened next would play out over a single, unforgettable weekend. Panic was setting in. Lehman had days, maybe hours, to find a solution. Across town, U.S. regulators were watching closely and growing very nervous. They understood the potential consequences of a disorderly collapse. Treasury Secretary Hank Paulson and New York Fed President Tim Geithner began working the phones. Their goal was to find a private sector solution before markets opened again. They had just spent billions rescuing Bear Stearns and helped take over Fannie Mae and Freddie Mac. Any further rescue would face intense scrutiny. That rescue alone had already cost roughly $200 billion in support. It happened just days before the Lehman crisis peaked. This time, Paulson made something very clear. There would be no government bailout for Lehman. He wanted to signal that firms couldn't simply expect rescue after taking excessive risks. If Lehman wanted to survive, it would have to find a private buyer fast. The pressure on Lehman's leadership had never been higher. That set the stage for one of the most intense weekends in financial history. Almost nobody involved got much sleep. On Friday, September 12th, top Wall Street executives were summoned to an emergency meeting. Few fully grasped just how serious it would become. The heads of nearly every major bank in America sat around one table. It was an extraordinary gathering of financial power under one roof. Paulson's message was blunt. Find a way to save Lehman yourselves. The government would not write the check. The clock was ticking. Markets would open again on Monday morning, ready or not. Two banks emerged as possible buyers, Bank of America and the British bank Barclays. Teams began reviewing Lehman's books at breakneck speed. For a moment, it looked like Bank of America might step in and rescue Lehman. Lehman executives allowed themselves a small measure of hope. But over that same weekend, Bank of America quietly turned its attention elsewhere, toward Merrill Lynch. That pivot removed one of Lehman's two remaining lifelines. By Sunday, Bank of America had agreed to buy Merrill Lynch instead of Lehman. Attention now shifted entirely to Barclays. One rescue option was gone. Only Barclays remained. Through the weekend, Lehman and Barclays worked furiously on a deal. There was real momentum toward an agreement at several points, but Barclays needed approval from British regulators before it could commit. That approval process typically took time Lehman simply didn't have, and British regulators were deeply hesitant to approve such a risky, rushed deal. Their caution, while understandable, would prove decisive. They worried that if the deal fell apart later, Barclays and Britain would be left holding the wreckage. Nobody wanted to be responsible if things went wrong. By Sunday afternoon, without regulatory approval, Barclays walked away from the table. Lehman's negotiating team was left stunned. Just like that, Lehman's last realistic rescue option was gone. The mood inside Lehman's offices turned from tense to grim. It was Sunday night. Markets in Asia would open in just hours. Lehman's leadership made one final, desperate round of calls, searching for anyone willing to help. None of those calls produced a workable answer. Inside the Federal Reserve, Paulson and Geithner faced an impossible decision. Both men understood the precedent that direct intervention would set. If they bailed out Lehman after saying they wouldn't, would every bank on Wall Street expect a rescue next time it took a risky bet? This question of moral hazard sat at the center of the debate. In the end, the answer was no. There would be no rescue. Lehman Brothers was on its own. There was nowhere left to turn. There was only one option left: bankruptcy. Lehman's lawyers began preparing the filings through the final hours of the weekend. In the early hours of Monday, September 15, 2008, Lehman's lawyers filed for bankruptcy. Word spread through financial markets almost instantly. It was the single largest bankruptcy filing in American history. It remains one of the largest in world history even today. Lehman listed over $639 billion in assets, gone virtually overnight. The scale was almost impossible for outside observers to process. 158 years of history ended with the stroke of a pen. It's a sobering reminder of how quickly trust can unravel. And this was only the beginning of the chaos. The next phase of this crisis would move even faster than the first. Monday morning, September 15th, New York woke up to the news. Thousands of Lehman employees arrived at work only to be told to pack their things. The atmosphere shifted from routine to devastating within minutes. Photographers captured the now famous image, employees carrying boxes out onto the sidewalk in stunned silence. Reporters lined the streets outside Lehman's headquarters. It became one of the defining images of the financial crisis. It remains one of the most recognizable images of that era. In total, 25,000 employees around the world lost their jobs. Offices in London, Tokyo, and elsewhere faced similarly abrupt closures. But the damage didn't stop at Lehman's front door. It quickly spread outward into broader financial markets. When markets opened that Monday, panic spread like wildfire. Investors rushed to reassess risk across their entire portfolios. The Dow Jones fell over 500 points in a single day, the worst drop since the September 11th attacks. Trillions of dollars in market value evaporated within hours. But this wasn't just an American problem anymore. Stock exchanges in London, Tokyo, and Frankfurt all posted steep losses. Banks and investors across the globe had bought pieces of Lehman's debt and mortgage products. Many discovered those holdings were now worth far less or nothing. The financial world was more connected than almost anyone realized. Lehman proved just how tightly interlinked the global system had become. When Lehman fell, that connection became a weapon. It became clear that no major player was fully insulated. One major money market fund, considered one of the safest places to keep cash, actually lost money because of its Lehman investments. For the first time in years, a fund broke below its expected stable value. For ordinary people, this was terrifying. If safe investments weren't actually safe, what was? Trust in the entire financial system began to crack. Some people began withdrawing funds out of sheer caution. Banks became terrified to lend money to each other, worried the next Lehman was hiding somewhere nearby. Interbank lending rates spiked sharply. This freeze in lending is often called the credit crunch, and it ground the global economy nearly to a halt. The effects rippled far beyond finance. Businesses couldn't get loans to pay employees or keep the lights on. Layoffs spread across industries that had nothing to do with mortgages. Millions of ordinary families lost homes, jobs, and savings in the months that followed. The human cost extended far beyond Wall Street. Just weeks after Lehman collapsed, the government did step in. But for the rest of the financial system, a new approach was needed, and it took shape quickly. Congress approved a $700 billion rescue package, known as TARP, to stabilize the banks that remained. It was designed to restore confidence and unfreeze lending. It was the very bailout Lehman had been denied, just a few weeks too late for them. The irony wasn't lost on observers at the time. In the months that followed, other giants nearly collapsed too. AIG, Washington Mutual, Wachovia, each required an emergency solution of its own. Most of them this time were caught by government rescues. The lesson from Lehman had clearly shaped the response. Lehman remains the one that was allowed to fall completely. That decision continues to be debated by economists today. In the years after, investigators dug deep into what really happened inside Lehman's walls. Their findings added important new details to the public story. A court-appointed examiner produced a 2,200-page report on Lehman's collapse. It remains one of the most detailed postmortems ever assembled. It confirmed Lehman had used accounting tricks like Repo 105 to hide its true financial condition from investors. It raised serious questions about oversight and auditing. Richard Fuld always maintained he did nothing illegal, and he was never criminally charged. That outcome remains a point of frustration for many, but legal and wise turned out to be two very different things. Legality alone doesn't guarantee sound judgment. So what actually caused this collapse? In simple terms, 3 core mistakes stand out clearly. First, too many risky mortgage loans were handed out to people who couldn't repay them. Lending standards had loosened dramatically. Second, Lehman borrowed far more money than it safely could to chase bigger profits. A 30-to-1 ratio left almost no room for error. And third, the true risk was hidden through accounting tricks and overly optimistic ratings until it was far too late. Transparency, or the lack of it, played a decisive role. Put those three things together, and collapse wasn't just possible, it became almost inevitable. The Lehman collapse triggered what became known as the Great Recession, the worst global downturn since the 1930s. Recovery took years in many places. Millions of jobs vanished worldwide. Trillions of dollars in wealth disappeared. In response, governments introduced sweeping new banking regulations like the Dodd-Frank Act. New rules were written to try to stop it from happening again. Regulators gained new tools to monitor systemic risk. And today, that lot in Manhattan holds no trace of the tower that once stood 158 years tall. But the history embedded there remains significant. Only a name left in history books and in every finance classroom since. The name has become permanently linked to the 2008 crisis. 3 simple mistakes. 1 unforgettable collapse. The world rebuilt, but it never fully forgot. Because every collapse leaves behind a lesson for those willing to learn it. Paying attention to those patterns is the real takeaway. Lehman Brothers didn't just lose $600 billion that weekend. It lost something even harder to rebuild than money. It lost 158 years of trust, built slowly and broken in an instant. Lehman is simply one of the clearest examples of that pattern, and that's a lesson worth remembering no matter what year it is. That's why this story continues to matter. If this story helped you understand money and markets a little better, consider subscribing for more. There's plenty more ground to cover together. We're covering more financial collapses just like this one, breaking them down simply, piece by piece. Stick around for what's coming next. Thank you for watching all the way to the end. I appreciate you spending this time with us. This has been the true story of how Lehman Brothers lost it all in one weekend. Hopefully it stays with you. See you in the next one. Thank you again for watching this deep dive from start to finish.